Hello and welcome again to Microeconomics. Today we're going to switch sides a little bit. The last few sessions we've been looking at the buyer side of the market. Most of the remainder of the semester we will talk about the seller side of the market and how pricing and production decisions are made by the sellers and the producers of the product. We oftentimes approach this as if we were actually producing the product, but the concepts are typically just as worthwhile whether we're actually producing the product or just reselling the product, or in the case of services, we're actually making the product even as we speak. The most important thing for us to begin to understand today is the whole idea of cost. Some of what we're going to start off with are cost reminders, things that we've talked about before. I want to remind you that one of the assumptions we've made about producers is that they maximize profits, and we'll come back to that concept a little later on, and that the cost, as economists refer to it, is the idea of opportunity cost. It is the foregone choices that we've made, and that we want to recapture that for all resources. As such, there are two different sorts of cost that we have to be very careful about and make sure that our concept matches what you're thinking. Accountants typically use the term cost, and what they mean is explicit cost. So in accounting, if you don't make a payment for it, if you don't write a check for it, it's not really considered to be a cost. And those are explicit costs. The way I always think of it is if there's a check written for it, then it's included. There is another type of cost, however, and this is the opportunity cost of resources that are owned by the firm's owners or the owner if it's a sole proprietorship. Oftentimes, it's the case that the owner doesn't actually receive a check for using their resources. And then in those cases, it would be called an implicit cost. It's the foregone opportunity of the resource, which we really need to include as we're decision making. It may not be necessary for tax purposes, but it's certainly necessary for decision making purposes. Now, let's look at an example which will give us a good feel for how this makes a difference. Here's a case where we have Wanda Wheeler. Wanda Wheeler is an aeronautical engineer, and she comes up with a new sort of wheel that has less friction than any other type. And so as a result, she decides to go into business for herself. She quits her job, and in her job she makes $50,000 a year. She also takes her savings. She has $20,000 worth of savings, and she takes it out of the bank. That savings was receiving interest in the amount of $1,000 per year. And she uses her own home, a piece of which she had rented to someone else before for $100 a month. So she is using her time, her talents, her money, and her own real property in order to do this business. In the first year, she has total revenues of $105,000. She sells $105,000 worth of her wheels. She pays an assistant a salary of $21,000 to keep the books and take the calls and process the orders and so forth. And she buys $20,000 worth of material and equipment in order to make the wheels. Now, from an accounting standpoint, her total profit would be $64,000. That would be the $105,000 minus the $21,000 for the assistant salary minus the $20,000 for the materials and equipment that she uses in doing her business. And that would be accounting for all of the explicit cost. But in reality, from a planning standpoint, Wanda's actually foregone $50,000 worth of salary, $1,000 worth of savings, and $1,200 worth of rental that she would have received otherwise. Now, those she didn't write herself a check for because she wants to plow that money back into the business, which is typical of a small business owner. But in reality, you should account for it, and those are known as implicit cost. And so in reality, rather than making $64,000 worth of profits, which would be the number that you would do for an accounting profit, the economic profit is $11,800. And that's the profit that's appropriate given the opportunity cost of what Wanda has put into the business for herself. So the accounting profit is just the total revenue minus the explicit cost. The economic profit is the total revenue minus all cost, both implicit and explicit, which includes the opportunity cost of all resources. In fact, we should have included in that a normal profit. That is a profit that would be attributable to her work as an entrepreneur. And what was left over then would be a true economic profit. So the accounting profit actually includes two different things. It includes not only the economic profit, which you could think of as over and above a normal profit, plus a normal profit for your contributions as an entrepreneur. So when you receive an economic profit, you're receiving more than what would be necessary in order to keep the business in business. A business could operate forever with simply a normal profit, and the reason being that we've accounted for all resources, the opportunity cost of all resources that are used in the business. Now, in order to understand how costs behave, one of the most important concepts is the idea of variable and fixed resources. There are some resources which we can add to the production process as needed. We don't need them all the time, but we can vary them as necessary in order to change the production levels. There are some other resources which are fixed in nature. They cannot be altered. The other concept that goes hand in hand with that is the period of time under consideration. In the short run, at least one resource is fixed, but in the long run, no resources are fixed. So the very idea of a fixed resource is a short run idea. If there are any resources that are fixed, if there are any resources that can't be altered, plant, equipment, land, the number of people that you have on payroll that can't be changed in any way, then you have a short run phenomena. If everything is variable, then it's a long run phenomena. And so obviously the long run is longer than the short run. From this, we could define a production function. A production function is simply a mathematical relationship which relates the level of resources employed and the total amount of output, or the total product. You could think of this as a physical count. In fact, many texts refer to this as total physical product, where we're simply going to say, if I change the amount of variable input, what happens to the total output? Now, what's going to turn out to be important to us is how much is it changing for each change in the level of input. As I change the level of inputs, what's going to happen to the marginal product, or the change in the total product, as I add that resource? Because as we're considering employing additional resources, what we really need to figure out is, what am I going to get out of this if I employ that one additional resource? What we discover is that as we increase the level of variable input, at least initially we get increasing marginal returns. That is, the total product increases initially, but eventually the total product will decrease. The marginal product, or the additional product, will ultimately decrease. And this is known as the law of diminishing marginal returns. The law of diminishing marginal return says as you add more and more variable inputs to a fixed input, eventually the marginal product will decrease. Now, as we saw from the previous slide, that doesn't happen right away. It takes a while for that to come into play, but it does eventually happen. So let's look at a production process. Here we're moving furniture or moving equipment, and we have a fixed factor, that is our truck, and our truck is rented. Nothing we can do about it. We can't change the truck into two trucks. It can only be one truck. And so the question in our mind is, how many workers should we employ? Now, the production function would be the relationship between the first column, that is the number of worker days we have, and the second column, which is the total product that we get moved, measured in tons moved per day. And we see, as we would expect, if we have no worker days, then our total production is 0 tons moved. However, if we employ 1 worker, then we end up having 2 tons moved per day. If we employ 2 workers, then we end up having 5 tons moved per day. 3 workers gives us 9 tons, 4 workers gives us 12 tons, 5 workers gives us 14 tons, 6 workers gives us 15 tons, and 7 workers gives us 15 tons. And if we employ 8 workers, we actually end up with 14 tons. Obviously, we're not real interested in adding the 7th worker, because as we add the 7th worker, we actually see we get no increase, and they don't come free, so as a result, we're certainly not interested in that. However, if you look at the last column, the marginal product column, you'll see that things are actually getting worse quicker than you would anticipate. Marginal product is just the change between the 2 workers. So as we go from 0 workers to 1 workers, that worker adds 2 tons per day. As we go from 1 worker to 2 workers, that worker adds 3 tons per day. And as we go from 2 workers to 3 workers, that worker adds 4 tons per day. Now you can see that during this entire time, we get increasing returns. The marginal product actually increases. But look at what happens from that point on. As we go from 3 to 4, we get an additional 3 tons. Now what's happening is we're getting into the law of diminishing marginal returns. As we add additional workers, we're not getting as much additional product. And as we go from 4 to 5, we only get 2 tons. 5 to 6, we only get 1 ton. And then when we go to 6 to 7, we get 0, and 7 to 8, we actually get negative. So clearly, somewhere in that area is the place that we want to be at. And clearly, our change happens earlier than we thought it would. Now, if you draw these relationships out, what you see is the total product curve goes up to begin with, and it goes up fairly steeply right to begin with. And we see the increasing marginal returns as a result of adding additional workers. Now, if you carry that down to the marginal product curve, you see that it actually peaks at 3 workers. So these workers add more to the total product, and then we begin to get diminishing marginal returns through this segment here, which essentially means that this curve is beginning to flatten out up here. So we see as we add the 4th worker, it's not as much, 5th worker, not as much, and so forth. And then ultimately we hit this point, and at this point it actually starts turning negative, and we begin to see down here that we're actually getting negative amounts. Hiring additional workers at this point actually reduces the total amount of product that we're producing. Now you may be thinking, does this answer the question of how many workers we want to employ? And the answer is, it gives us a hint, but it really doesn't tell us yet, does it? Because as yet, we've still only got product numbers. We don't really have any dollars and cents, do we? So the next step along the line is to convert all of these product numbers, these actual tons of moving, into actual cost, and then we can begin to decide how many additional workers do I want. Ultimately, what we want to do is to say, how much does each worker bring us? Does that worker bring us more than they cost us? And if they bring us more than they cost us, then we want to employ them. If they don't bring us more than they cost us, then we don't want to employ them. We'll stop there for this time, and next time we'll talk about the cost portion of this. Thank you, and see you next time.